Well, what got the sell-off started on Monday and then some follow-through again today were some more statements from some Fed guys about the prospects of the Fed having to go higher for longer when it comes to interest rates. And in fact, that point got hammered home yesterday with the release of some economic data that was actually stronger than the markets had been anticipating. First of all, we got the Chicago PMI for November, and this one wasn't necessarily a beat because I'm not even sure what they were looking for, but the index came out at 46.4 and the service index came out at 46.2. Now that one was actually a slight miss because they were expecting 46.3. But again, anything below 50 represents contraction. So regardless of what investors were expecting, that was definitely a weak economic number. But the surprise came when we got the ISM Services Index for November, which was supposed to come in at 53.5, which would have been a decline from the 54.4 from the prior month. And instead, it came out at 56.5. So instead of going down, it went up. And not only did it go up, it was above the upper end of the consensus range, which went from 51.5 to 56. So this was definitely a stronger data point than the markets had been expecting. We also got a beat on October factory orders, which were supposed to rise by 0.7, and that would have been an increase of the 0.3 in the prior month, but instead we had an increase of 1%, and so that too was a beat, and that was a 1-2 punch because as soon as these numbers came out, the S&P futures sold off sharply and they never recovered. Gold dumped. I think on the day gold was down about $30. All of the losses came as a result of that release, and the idea that this strong economic data is going to prevent the Fed from recognizing that the inflation threat has subsided, and it's going to result in the Fed making a mistake and raising rates too much or leaving them too high too long and causing this unnecessary recession. And stocks are getting hurt for a couple of reasons based on that. One, of course, the higher interest rates are automatically a negative for stock market prices because of the impact on valuations, because the higher the rate is, the lower the discounted present value of future earnings, which is what stocks represent. But also, if the Fed causes this unnecessary recession, that will depress earnings, and so stocks have a lower value when they have lower earnings. And of course, corporations have a lot of debt, and so higher interest rates directly subtract from earnings by running up the interest expense. So all of this is scaring the stock market. But of course, the reality is we're already in recession and we don't have a strong economy. Yes, every once in a while, we're going to get some data that comes out stronger than expected, but most of the data is weaker than expected. And even the data that is stronger than expected, like the most recent non-farm payrolls report, but all of the strength is superficial. Look beneath the surface, and the reality is weakness. You know, it reminds me of Sam Bankman-Fried. I mean, we've got a Sam Bankman-Fried economy. We've got a Sam Bankman-Fried job market. Because if anyone had bothered to look beneath the surface of what was an obvious fraud, his whole empire would have been revealed as a scam. Everybody just accepted the fact that this guy was worth close to $30 billion and that he had all the money to do everything he was doing. Nobody bothered to question how it was possible that this guy could possibly have so much money based on the business that he claimed to have. Nobody really looked beneath the surface, and nobody questioned some of the ridiculous statements that he was making and the self-serving nature of a lot of the companies that he was rescuing. He was basically rescuing himself. He was probably trying to prevent bankruptcies of other crypto companies that were involved with FTX from revealing the underlying problems at FTX. But the same thing is true with respect to the U.S. economy or the labor markets. don't accept the numbers at face value. Dig a little deeper and look at what's actually happening. Because if you do that with the jobs numbers, the jobs market isn't strong. The jobs market is weak. And the risk that everybody is worrying about is once again the wrong risk. It's not that the Fed is going to raise rates too much. It's that they're not going to raise them enough. It's that they're going to pivot too quickly. It's not that the Fed is going to mistakenly believe that the economy is strong and then to overestimate how high inflation will be. It's the weak economy that's going to cause inflation to be higher. Because as the economy weakens, production will decline, but money printing will expand. In fact, at some point, the Fed will pivot in response to a much weaker economy than it expected. And that's when the dollar is really going to tank. And that's when consumer prices are really going to take off. The inflation that we're experiencing now is going to kick into a much higher gear during the next economic downturn. That's what nobody understands. Everybody just assumes that when the economy weakens, so too will inflation. No, the weakening economy is going to strengthen inflation because inflation is the expansion of the money supply. And the weaker the economy gets, the more the Fed is going to expand the money supply to try to stimulate it. And as the return of quantitative easing causes a mass exodus out of the U.S. dollar from foreign central banks and private holders, then the falling dollar is going to push consumer prices up dramatically, also increasing the size of our trade deficits and our current account deficits, creating a self-perpetuating spiral of inflation and economic weakness. But getting back to what happened in the stock market these past couple of days as a result of this stronger than expected data that came out on Monday, the Dow is now down about 830 points in 2 days. That's a 2.4% drop so far this week. Now, for the month of December, which includes another 2 days, it's down 2.9%. S&P 500 is faring even worse. It's down 3.2% in the last 2 days, and it's now down 3.4% for the 4 days of December. This is the fourth consecutive day that the S&P is down. So it's been down every trading day of the month so far. The Nasdaq doing even worse, down 3.7% this week, 4% this month. And if you look at the more speculative names in the Nasdaq, the Cathie Wood ARK Innovation Fund, that's down 9.3% this week alone. Its biggest holding, Tesla, down 7.7% on the week. Now, the gold stocks are also down. Gold stocks are down 3.6% so far this week. But for the 4 days of the month, they're barely down. The decline is less than 1% on the GDX. Gold itself is down 1.4% in the past couple of days. Silver down about 4%. But on the month, silver is basically flat. So most of its gains it has retained. In fact, the stock market has given up all of the gains since Powell's speech last week, where the markets rose in the face of his hawkish comments. But the gold stocks have not. In fact, the gold stocks are still up about 6% from where they were before that speech was given. So despite the big drop over the last 2 days, we still see a lot of strength in the gold stocks. And I expect that to continue.